Good afternoon, everybody, and welcome to our special session today at Davidson & Company called Light at the End of the Tunnel. My name is Rez Bahar, and I'm an audit partner here at Davidson & Company, and I'll be moderating this session. We are here live in downtown Vancouver at the headquarters of Davidson & Company, and while this does remain a Zoom session, as we always mention, we can't wait, hopefully at this time next year, to bring back the live sessions. So given that this is going to be a Zoom call, throughout the session, if you have any questions, please feel free to type them in the Q&A function. And after the speakers that we have today, we'll get into a session later on. So please submit those online and we will make sure that we attend to those. If for some reason we can't answer your question right now, you can always email us at events@davidsonandcompany.com and we will make sure that we answer your questions promptly. So today we decided to do a session called Light at the End of the Tunnel. And even though clearly the pandemic is not over, we do believe we're at the tail end of that. And there's quite a few accounting, auditing, and valuation and taxation issues that have popped up recently in public markets that we thought would be worthwhile attending to, especially with some of the hot topics that we have today. So we've got three speakers today that have volunteered today to present with us, and we're thankful for that. We're going to have Carmen Newman present today, and she's going to talk about involvement in offering documents. And Carmen has a newborn at home, and we're very thankful that she came here today to join us. And Carmen's a very active person, and that's what she does in her spare time when she doesn't spend with her family. And then we're going to talk about M&A tax considerations. And we have Howard Chung here present with us. And Howard's a principal here at Davidson & Company. And Howard also has a couple young children at home. And so his hobbies is hanging out with his family and working. And then lastly, but not least, we're going to have our valuations partner, Mark Weston, represent how has COVID impacted valuation issues, and in particular with how do companies look at their cash flows during the pandemic. And then afterwards, we'll have the Q&A session. And again, a reminder that if you have any questions, please do type them in the Q&A function. And then we're going to usually do a door prize as well at the end. And similar to last few times, we're going to be drawing out Starbucks gift cards because there's quite a few Starbucks locations remaining in downtown Vancouver. And we're hopeful that you will use that gift certificate and come down and have a coffee with us when the time comes. And at the very end, I'll come back and talk about a few upcoming events as well that Davidson & Company is going to put on for the remainder of the year. We are open here at the office. We've been open the entire time during this pandemic. And as usual, we miss all of you, our clients who continue to support our firm and continue to attending these sessions, which is very important for us. And so we thank you for that. So now our first speaker, as mentioned, Carmen Newman, who's going to be talking about auditors' involvement in offering documents. So Carmen, welcome.
Great, thanks, Rez, and good afternoon, everyone. So I know everyone's had a rough time over the past year or two with COVID, but unexpectedly, we've also seen a number of companies completing financings in the form of short form prospectuses. Oftentimes, we get a lot of questions or there seems to be some confusion about the steps that are involved in this. So we thought it would be a good idea to go over at a high level those steps. Step 1, expected timeline and nature of each party's involvement. So the parties involved will be management, of course, legal counsel, your auditors, as well as your agents and underwriters. Don't get me wrong here. This is definitely the lawyer's show, as they'll be the ones who take the lead on drafting the document, discussing with regulators, letting you know the processes for management. But it's definitely important for us as auditors to know what we need to do to assist. That's why it's very important for management to create a timeline and circulate this to each of the parties. Then we'll be able to adequately put the resources, as we know these can be very time-sensitive documents. Step 2, engage Davidson for prospectus involvement. This is actually something that needs a separate engagement letter, as we will have to give consent for our auditor's report to be included in this document. In addition, we will also have to circulate an understanding letter to your agents or underwriters. It's great to get this out of the way at the beginning, as we must obtain receipt that they got the document prior to entering into any discussions with them. Step 3, engage Davidson to perform an interim review. So included in this document will be your audited financials as well as your most recent interim statements. They'll either be included or referred to and referenced to. What many people forget is that these interim statements will have to be reviewed. We'll need sufficient time to be able to complete this. I generally say 2 weeks. However, this can definitely vary depending on the size of the company as well as the time of year. So you want to make sure that you leave sufficient time in your timeline for this. A second point on this is you don't want these interims to go stale dated and then have to do the next Q. So make sure again that you're picking the right Q to be included in the document. Step 4, provide Davidson a copy of the short form preliminary prospectus. So as mentioned, we'll be issuing a consent since our audit report will be included in the document. Therefore, we'll be required to review the full document. If there's information in the document that we haven't looked at, financial information that is, in either our audit or review, we'll need to obtain working papers, potentially agreements associated with that. So ensure to have this readily available. Step 5, due diligence meeting. This will depend on the requirements of your agent or underwriter, but if required, ensure to give us at least 2 to 3 days notice prior to the meeting. We'll need to make sure we have sufficient time to draft, have internal review and approval of our responses. Also, back to the timeline, we'll likely need to be sufficiently completed our interim review at this stage, as some of the questions will draw on our review engagement. Step 6, circle up documents. As part of their due diligence, your agents or underwriters will go through your most recent filings, financials, MD&A, AIFs, change management reports, anything that's filed on CDOR, and circle up certain items that they will want your auditor to provide a comfort letter on that addresses what work was done on those figures. Again, back to the timeline. This takes time, so ensure you leave sufficient time for us to complete the circle up, as well as go back and forth with the agent if any questions that they may have. Generally speaking, they'll want to see a draft of this prior to your preliminary filing. Step 7, set the preliminary short form prospectus filing date. As you'll notice, this is a separate step than actually filing your prospectus, as there are certain procedures your auditor must do. We'll need to do updated subsequent event procedures, get an updated management rep letter, as well as obtain updated legal letter. Therefore, we'll need about 2 days before the actual filing date. Step 8, file the preliminary short form prospectus. Step 9, provide the comment letter and draft management responses. Step 10, set short form prospectus filing date. We'll need to repeat the procedures outlined in step 7. So again, ensure we have sufficient time. Step 11, bring down due diligence meeting. The agents or underwriters may request us to have a second meeting whereby they want to reconfirm questions that were asked at the preliminary meeting. Again, make sure we're given the list sufficient time so that we can draft our responses, go through internal review and approval. In addition, the underwriters may request a bring down comfort letter. So this will likely be dated the same date as your filing date. Now we're here, file the short form prospectus. So as everyone can see, there is probably more than anticipated steps involved in this. So it's always beneficial to have a good timeline and ensure all parties are aware of what's involved. Your auditors will always be here to assist you. So please feel free to reach out with any questions if you're looking to do this in the near future. That's it for me. So I'll hand it off to Howard, who will be discussing tax considerations for M&A transactions. And don't forget, if you have any questions, write those down.
Good afternoon, everyone. My name is Howard, and thank you all for joining us today. As companies are struggling or thriving through the impact of COVID, we have seen a significant uptake in M&A activities. So today I would like to share with you some M&A tax considerations. One of the first questions when considering a purchase or sale of business is whether it would be an asset or share purchase. In an asset purchase, the purchaser will have a step up in tax basis, whereas in a share deal, the existing tax attributes are inherited. This is also the case for internally generated intangible assets as well as goodwill. On the other hand, there are certain tax attributes that will remain in the target corporation, such as tax losses and tax credits. To obtain these, it would have to be a share deal. These tax attributes are also subject to the loss restriction events, which we'll discuss further later. Another key difference between an asset and share deal is the tax implication to the seller. Typically for sellers, when selling shares of the corporation, they will realize the capital gains, which is typically 50% taxable. In addition, if the shares qualify as qualified small business corporation shares, the sellers may have access to lifetime capital gains exemption. On the other hand, on the asset deal, the corporate level, there may be recapture of tax attributes, tax depreciation, as well as capital gains. And when the funds are being extracted from the corporation, there may be a second level of tax as well. In a share deal, the purchaser will inherit all liabilities, contingent or actual, from the target corporation. Whereas an asset deal, typically you can negotiate what liabilities you would like to assume. So we generally recommend that tax due diligence be performed in the share deal. Lastly, in an asset deal, the transfer tax on real property as well as sales tax should be considered. Generally, purchasers prefer asset deals and sellers prefer share deals. So these should be considered. The tax implication on both sides should be considered when negotiating for a sales price. If a decision has been made to purchase the shares of target, there are a few common acquisition structures that can be implemented. In the examples that we'll go through, we will assume that the target company, as well as the purchaser, are taxable Canadian corporations, and the target shares are considered capital properties to the sellers. The most straightforward structure would be a direct purchase. So the purchaser could be paying cash or non-share consideration, such as a promissory note, to the seller. The seller would realize a capital gain. If the shares of purchaser are issued as part of the consideration, there could be a deferral of the capital gains to the seller. There could be through either automatic rollover or elective rollover. The elective rollover is typically referred to as the Section 85 election. If a Section 85 election is available, the purchaser, as well as each of the sellers, will agree on the value at which the shares of target will be transferred, and this is for tax purposes. Often a full rollover is desired, but there are times where a partial rollover is preferential to the seller if they want to utilize their capital losses or lifetime capital gains exemption. Where target is a widely held public corporation, elective method may be more cumbersome. One opportunity here is triangular amalgamation. So in these situations, the purchaser will typically incorporate a subsidiary, Canadian subsidiary, to be merged with the target company. The amalgamated company, instead of issuing shares to the seller, they will issue all the shares to the purchaser, and the purchaser will then issue the shares to the sellers. Under the Act, this arrangement, the triangular amalgamation, is fully tax deferred for both the seller as well as the purchaser. In this situation, the rollover is automatic and not elective, but is also less flexible in the sense that you cannot choose the price at which you want to transfer. So therefore, choosing the optimal acquisition structure will depend on the situation. The purpose of the acquisition control rules, or the AOC rules, are to limit the purchase and sale of tax attributes among arm's length parties, especially when it comes to unrelated businesses. A corporation is subject to the AOC rules, where its control is obtained by a person or group of persons. In addition, the AOC rules also apply in a situation where the purchaser, when acquiring the shares of Target, has issued to the sellers its shares, and the sellers, when viewed as a single person, has control over the purchaser. This is often referred to as the reverse takeover or RTO. In these situations, both the target as well as the purchaser are subject to the AOC rules. When a corporation is subject to the AOC rules, the corporation is deemed to have a taxation year end that ends the day before the acquisition date. This means the corporation and all its Canadian subsidiaries will have a stub period taxation year and have to file tax returns. In addition, often companies want to align their taxation year end with that of the purchaser, so therefore there may be another stub period tax return that needs to be filed. These stub periods will accelerate certain provisions in the Act that refers to taxation year rather than year. So for example, tax losses and tax credits will age a bit faster. Deferral from certain reserves will be shortened, and the timing of the payments that need to be made in order to avoid certain income tax inclusion will be accelerated as well. Tax deductions that's calculated based on number of days will also need to be prorated. The AOC rules also require the write-down of inventory and capital property to their fair market value. This will result in unrealized capital losses and non-capital losses to be realized earlier for tax purposes than the general triggering events. In addition, certain tax attributes such as tax losses are streamed to the business that's operated pre-AOC. So for example, in order to utilize the pre-AOC losses in the post-AOC period, the business that's the pre-AOC business needs to be operated throughout the year and with a reasonable expectation of profit. And the income from which the losses are being utilized against needs to be from that business or a similar business. Lastly, pre-AOC capital and property losses will expire at the end of the AOC period. These rules work together to limit the amount of tax benefit that can be utilized by the purchaser's group after the acquisition. After an acquisition, the tax balance of the target's opening balance sheet should be reflecting any purchase price allocation. Deferred tax assets and liabilities often arise in a share deal, given that the purchase price allocated to an asset or liability may differ from the tax basis. In a share deal, there's typically less of an issue because the step up in tax basis. Under IFRS, the first step of the analysis is to determine whether the acquisition is a business combination under IFRS 3 or is it an asset acquisition. If the transaction qualifies as a business combination, the deferred tax assets and liabilities needs to be calculated and recognized subject to the general recognition rules. Where the transaction does not qualify as a business combination and at the time of the transaction affects neither the accounting nor taxable profit, the DIT asset and liability is not recognized. This is often referred to as the initial recognition exception or the IRE. The IRE also applies to the initial recognition of goodwill, regardless of whether it was a business combination or not, to the extent it would have resulted in a DIT liability. The portion of temporary difference that is subject to the IRE should be tracked, as the reversal of this amount will have an impact on the deferred tax calculation in the future. Lastly, I want to cover a few tax considerations when dealing with cross-border transactions. A purchaser buying taxable Canadian property, or TCP, from a non-resident seller has to withhold 25% and remit 25% of the purchase price and remit to the CRA on account of the seller's Canadian tax liability on the disposition. This is considered to be the purchaser's liability, and the purchaser has a lawful right to withhold this amount from the purchase price. The seller may choose to apply for a clearance certificate or a compliance certificate. And if the CRA were to issue this certificate to the purchaser, then the liability may be reduced or eliminated. And a TCP includes a real or immovable property that's situated in Canada, as well as shares of private corporations that derive more than 50% of its value from such property in the last 60 months. It should also be noted that the purchaser liability, like most withholding taxes, are not statute barred. A non-resident purchaser may fund the acquisition of Canadian companies through a combination of debt and equity. Funding with debt can increase the tax deduction available in Canada. In Canada, the thin capitalization rule allows for a debt to equity ratio of 1.5 to 1. This means in general, the purchase price may be funded with 60% debt and 40% equity without triggering the thin cap rules. Once the ratio is exceeded, the interest on the excess debt is non-deductible and is treated as a deemed dividend, which can attract withholding taxes. Lastly, whenever a non-resident corporation or a public corporation acquires a Canadian controlled private corporation or CCPC, the target company loses its CCPC status as well as the benefit that comes with it. This can include the small business deduction, the investment tax credit at a higher rate, as well as the refundability of certain tax credits. There's also a deemed taxation year end that ends immediately before the status change. So there may be multiple year ends to a single acquisition. And that's all I have for you today. If you have any questions, please submit to events.davidson. And that's thank you for listening. I'll pass it on to Mark Weston, who is our valuations partner.
Thanks, Howard. It's good stuff. Good stuff. Thinking back at the title of this, it's a changed world. It is a changed world. What's changed? Risk. Uncertainty. Uncertainty leads to opportunity. Maybe the light at the end of the tunnel. Opportunity. Maybe it's more uncertainty. It's hard to say. Interesting, these three presentations really present a timeline from uncertainty, from opportunity, comes mergers and acquisition opportunities, tax restructuring. A really good thing that Howard mentioned was purchase price allocations. From an M&A transaction, tax restructuring comes the need for business combination, purchase price allocations. So we see a common thread. We see uncertainty, we see opportunity. That's a light at the end of the tunnel, really, is the opportunity. And that's what I want to focus on. And an integrated approach to dealing with opportunity and growing business. I'm going to deal with four things here. Some of these you'll have recognized from previous presentations of mine. Talk about fair value. What is it? How is it measured? How is it impacted by uncertainty or opportunity? More importantly, though, how are you impacted as clients, as management of public companies or private companies? How do you choose to deal with uncertainty or opportunity? Let's talk a bit about fair value once again. We've heard this before, and I'm going to apologize for repeating myself, but it's important. Because fair value, as I've said many times, is an exit price. It's not what you pay, it's what someone else would pay you. So think about that. How do we consider opportunity and risk in the context of fair value? And fair value, by the way, that notion of fair value is prevalent throughout all stages of financial statements. Fair value measurement. Probably one of the biggest issues, I'd say, these days. So once again, it's an exit price. It's the price you would receive if you were to sell the asset or pay if you had to transfer the liability. At a measurement date, and this is very important too, we're going to talk about the impact of different measurement dates on this. So once again, the price that you would receive if you were to sell the asset or pay if you were to transfer the liability at the measurement date. That's a key point. The measurement of that. So let's continue on here. How is fair value measured? And more importantly, how is this impacted by COVID? So fair value is really measured in accordance with IFRS 13, provides a structure. IFRS 13 also talks about various levels of input, observable inputs and unobservable inputs. I want to focus on those because as clients, those are the inputs that present you with problems, with challenges. Let's talk about some of those unobservable inputs. The key thing when we're talking about unobservable inputs really are those inputs that you provide in the context of a cash flow, management's financial projections. Let's think about how those are impacted by COVID. Step back a bit though. How are those used in general? Typically, when we have a business combination or an impairment analysis, one of the things used clients are asked to prepare is a cash flow projection. That cash flow projection now is very important that you prepare that from the perspective of a market participant. Keep in mind that what we're trying to do here is arrive at the price that you would receive if you were to sell the asset. Not what you pay for it, what you would receive if you were to pay to sell the asset. How are those particular projections impacted by COVID? COVID presents risk or opportunity. What's very important now is to clearly document and articulate those particular inputs. Why? Those inputs are going to be given to the auditors. Those auditors then going to need to obtain evidence, sufficient appropriate audit evidence to support them. The process continues, and then we have a fair value measurement. So let's step back for a second and look at it. As I have here in our slide, measured using assumptions that market participants would use, including assumptions about risk or opportunity. So let's look at some of those assumptions. Your typical cash flow projection contains revenues. Number of widgets times the price for a number of years. It contains assertions regarding expenses, cost of sales, operating expenses. How are those impacted in this COVID? Now let's think about this environment. So really, we have various stages of COVID, various waves. The first wave, the second wave, the third wave, the fourth wave, which we're in right now. What's the impact of that? Let's think about dates for a moment here. Fair value is measured at a particular point, at a measurement date. What if you were preparing a projection as at December 31st, 2019, but you're preparing it today, getting a couple years of financials done? How would you deal with the presence of COVID in those projections? Think about it. At December 31st, 2019, what were people thinking about? Were you thinking about COVID? Perez, were you thinking about COVID? I don't think so. Nobody was thinking about COVID. We heard about it. We didn't know what the impact was. As such, when you're preparing your projections as at that particular date, think about a market participant's point of view, people would not have fathomed the impact of COVID. As such, your projections for revenue would not be impacted by COVID. Your projections for expenses would not necessarily be impacted by COVID. Your fair value measurement itself at that particular measurement date would not necessarily be impacted by COVID. Let's fast forward a bit. What about June 30th, 2020? Well, we were sort of in the beginning part of COVID. We knew something was going to happen. We knew it was going to impact us somehow. Did we really understand the impact though? Probably not. How does that once again impact revenues? We would have increased uncertainty that might be reflected in a higher discount rate. It might be reflected in slightly more conservative revenue projections. But at that point, I would guess that it wouldn't have, no one would have guessed what the impact was, the global impact at that particular day. So once again, fair value measurement says the price that would be received, fast forward, at the measurement date. Put ourselves in that particular perspective from a market participant's point of view. Fast forward a bit more, December 31st, 2020. Now we're right in the middle of it. Your projections are going to be slightly different now. Now what I would expect to see is more and more uncertainty. How does that uncertainty impact you? Your workload as manager. Well, the first thing, you prepare financial projection. You give it to one of our audit team, our audit partner would look at it, they talk to me. The first thing that we talk about is, well, can you support these projections? Are they the same projections that we actually used 6 months ago, 8 months ago, 12 months ago, when nobody really understood the impact of COVID? Hopefully not. In some cases, they may actually be more aggressive and it may make sense. What if you're a telecommunication company and you see wonderful opportunity from COVID? Zoom, for example. On the other hand, what if you have a collection or portfolio of restaurant or leisure activity type companies? Very different impact. Starting point. You need to be able to articulate to auditors how COVID has impacted you. How COVID has impacted your competitors, which are the market participants. How COVID has impacted your suppliers. Are there supply chain issues? Does your product contain microchips? Because if it does, you can't get microchips for 2 years. How are you going to deal with that? How elastic is your price to changes? We can't get microchips, so we have to pay more for them. We're going to pass it on to the consumer. Do you still have an aggressive projection? Maybe, maybe not. The important thing here is to be able to answer to Carmen or to Rez. Here is my business. Here is how it's impacted. Here is how we support our assumptions from the perspective of a market participant. Very important. How is measurement impacted? We already talked about a couple things. Risk inherent in the cash flows is probably the big one. What about other type of risks? What about foreign exchange? What about commodity price? Is it risk or is it opportunity? I would say that if you're a telecommunications company and your projections have an increase in revenue, I'd say that's fine, provided you have the narrative to support it. So once again, one of the most painful, I imagine, experiences for you as clients is when we come back to you continuously. Provide more support, please. Provide more support, please. Provide more support, please. You could make your life a lot easier. Once again, the narrative, because obviously the narrative is what drives the value. Start with that narrative. Start with the risks. Other types of risks, when we're talking about liabilities, credit risk, counterparty risk, your own risk, liquidity risk. Those are other factors to consider. Lastly, how are you impacted? Got 3 points here. The first is, of course, how is your business impacted? Is it a risk or is it an opportunity? Regardless, as a result of the uncertainty present in this fourth wave, maybe there's a fifth wave, hopefully not. Regardless of that, the workload with respect to supporting those key audit assertions, those key assumptions in your projections has increased. So we're all going to be impacted by that. We're impacted. Secondly, what about the risk associated with the overall discount rate used? Now, very seldom do I see a client that does a detailed calculation of the discount rate. And quite frankly, it doesn't bother me. I wouldn't expect you to do that. However, from a consistency point of view, let's think about it. You're working with Carmen, Rez, or one of our other partners. You prepared a purchase price allocation, and more importantly, how about an impairment analysis? Take a look at 2 years ago, the discount rate you incorporated was 18%. What discount rate are you incorporating today? Is it lower? Is it higher? Is it the same? Should it be higher? Is there more risk? Should it be lower because there's more opportunity? Who knows? The narrative is what counts. So the narrative. The last thing that is putting back to this, it's in this area, disclosure. Think about it. In this COVID world, with increased opportunity or increased risk, there's also a need potentially for increased disclosure in some of the notes. Think about the impairment. You think about those key assumptions. Also think about the need for sensitivity analysis incorporated in the body of those notes. How sensitive is this impairment analysis to changes in the discount rate? More importantly, how sensitive is it to changes in the revenue growth rate? What about the EBITDA margin? What about cost of sales? What about your key supplier? What about that microchip supplier? How is that impacted? Big picture. Identifying risk or identifying opportunity leads you to potential opportunities to make acquisitions, potential opportunities to identify tax planning opportunities. Lastly, opportunities to make your job as management preparing information that's given to auditors a bit easier by articulating the business, the challenges, the opportunities, the risks, passing it on to us. And hopefully this fifth wave, if it comes, isn't really a wave of risk. Perhaps it's an opportunity. It's a horizon of opportunities. And we'll all experience some good times. That's it for me. Look forward to your questions. Thank you.
Okay, great. Thanks much for that, Mark, and Carmen and Howard as well. And now we're going to get into a bit of a Q&A session. And we've got quite a few questions, so we're going to try to probably limit a couple questions per person. And Carmen, I'll start with you, if that's all right. Maybe come on up as well, if you don't mind. And thanks for that. How's it going, Carmen?
Good. How are you?
Good, thank you. We'll try to keep a bit of a social distance here, but I'll stand with you as well. So you talked about the process of an offering document going public. One of the common forms that people are using right now is like a shelf registration statement. Do you mind telling us a little bit about, are there differences between the shelf versus other offering document, or what's the difference between a shelf and any other offering document?
Yeah, no problem.
And do we still have to have the same level of involvement?
Yes. So the steps that I went over are basically the same for a base shelf prospectus. These have become really popular over the last year or two. The main difference is that it basically allows the company to get ahead of the paperwork. So they'll file the prospectus on CDAR with no intention of issuing the shares or doing the financing right away. And they'll have it all set up so that at a later date, or dates, if they want to do in multiple stages, can be done once they're ready. So again, just to save time, get the paperwork out of the way. Once they want to raise that financing, they're ready to go.
Gotcha. So a shelf prospectus doesn't mean they're issuing new securities. It's just getting ready for the potential of doing it.
Exactly.
So why do companies do it? Do they do it just to speed things up, or what's the purpose
Exactly.
of it?
Basically to have all the paperwork out of the way and have it ready to go for when they are ready. Also times they can do it in multiple stages. So they may want to do it over a course of a year and do a couple at 4 months, a couple at 6 months. The good thing to remember, or the thing to remember about that is every time you do that, there may be a supplemental filing involved. So we'll have to get re-involved. And back to your timeline, make sure to give us sufficient time to do our subsequent event update procedures, get that management rep update, as well as the legal review.
Okay, so companies can file a shelf prospectus, let's say they offering up to 100 million shares, but they can do it in stages. They don't have to do the whole amount at once.
Exactly.
Okay,
Yes.
gotcha. Okay, so it's to save time, is to get ready, but it doesn't necessarily state a number of shares or price. And then our process as auditors would have to be similar to other offering documents.
Exactly. We'll go through the same process at the beginning, and then any supplemental, those dates that you end up doing it, we'll get back involved.
Okay, great. And then the second question that came from the audience is, we've noticed that certain stock exchanges, for example, perhaps the CSC, doesn't always need a consent letter to go into, for example, a filing statement. So in the case of, for example, an RTO or a company that's about to list on the CSC, for example, and they don't require a consent from us, what would be the type of involvement that companies should consider? Do they still need to reach out to us, for example?
Yes, so this actually is a great point. Some people think, or some companies think, oh, there's no consent. We don't really need to get our auditors involved. However, if you actually read that engagement letter we send out during the audit, it says we do need to be notified. So anytime our audit report is included or referenced in any document, you must notify us of that filing. So we will need to get involved and go through the steps. We may not have to issue the final consent, but all of the steps will still be required, where we'll have to review the document, ensure we're all on the same page about all the information that's in it.
Okay, so it's a good reminder for companies that even if they don't need a consent letter from us, the auditors, they should still let us know that they're using our auditor's report because that's per stated in our engagement letter. And so we would provide like an internal consent in a way almost to use it.
Correct.
Okay, gotcha.
Correct.
Okay, great. Thanks very much, Carmen.
No problem.
Okay, Howard, if you don't mind, we'll get you up here next. And then for those of you who, I think Howard's one of the first time you're presenting with us, right, Howard?
Yeah.
Okay, well, Howard's been with us for a few years and he's got a wealth of tax knowledge. So thanks again, Howard, for joining us
No, no
today,
problem.
doing the presentation. There's a couple questions that came in that you may have just alluded to. Often with tax, if there's a change in control, there's a deemed year end,
Correct.
right? Typically for tax.
That's right.
And a lot of companies sometimes have gone through all their tax due diligence, but have perhaps missed the fact that there's a deemed year end. Could you let us know under what type of scenarios a deemed taxation year end could result in tax impact?
Yeah, of course. So there's, as mentioned, there's certain reserves. The deferral mechanism may be shortened. So for example, the capital gains reserve typically gives you 5 years to defer your gain if you haven't received the proceeds. But if you have multiple taxation years in between, because the reference is to taxation year and not year, let's say you have acquisition control, which gives you a stub period, cease to be CCPC, another stub period, pre-amalgamation, that's another stub period. You could have a situation where you have full income inclusion before you receive the proceeds. Another example is, for example, the unpaid remuneration rule, which I'm sure everybody's familiar with. Typically, you have 179 days after the taxation year end to pay your salary or bonus accrual in order for it to be deductible. And if it's past that date, it's not deductible until the time it is actually paid. So in an example, a corporation, let's say they accrued, let's say $100,000 of expense by June 30th, and they accrue another $100,000 by December 31st, assuming they have a December year end. But they have an AOC, that acquisition control, that happens on July 1st. So now when you're, and let's say they typically pay the bonus, let's say March of the following year, which typically in a regular year would have been fine. They would have been within that 179 days, and the expense would have been deductible in the December period. But let's say they have AOC that happens in the middle of the year. Now the March 31st date will be past the 179 days, and therefore it would not be deductible in the June period. But at the same time, it will also not be deductible in the December period because it's not paid in within the December period. So therefore, your income inclusion will be a bit earlier than compared to your the deduction that you otherwise get.
Okay. Okay. So a key takeaway there is if you have a deemed year and you lose a year, and so all the deadlines, whether it's 5 years, all get shortened, right?
That's
And
right.
sometimes even the deemed year could even be just a few days, right?
Correct. It could be actually on this. I've seen 3 taxation year on the same day before.
Yeah, like for example, if it's a calendar year end and a change in control occurs on December 29th or 30th,
Yeah.
you might have just a 1 or 2 day year end.
Correct.
So I guess the one strategy to be thought about is that if it has an impact, right? Because you lose a year, even though it might only be a day.
That's right.
So if I don't know if companies typically strategize about when to
It's-
close acquisitions.
If
versus
it's that
year-end,
close to
but-
year end, there's some elections that may be available.
Right.
So if it's within 7 days, there's actually election that for AOC, there's actually possible to time it so that it ends at the right timing.
Yeah.
But it's there's certain other things that like CCPC, CPC. Sometimes that's harder to time. So and acquisitions in general, unless you're that close to year end, people aren't going to wait for that.
Gotcha. Okay, great. And then the second question that came in, Howard, is visualize a typical scenario where company A wants to acquire company B, and there's some tax due diligence that gets involved. And as common, the seller would often do a lot of representations and warranties about balances or whatever it is, part of it. So the question becomes, if when a seller gives you all those reps and all those warranties, should companies still do tax due diligence with that?
Yeah, that's a great question. So it depends on a few things. So the target, how complex the business is, and what kind of risks there are there, and as well as your own risk tolerance. But I would say even if you have most of the tax reps and warranties in the share and the purchase agreement, there's a few things to consider. So one of them is that extended reps are often not feasible when it comes to public corporation acquisitions because there's so many shareholders. In addition, the timing, so how long these reps last, typically there's a time frame that the sellers are willing to rep for. But there are also tax liabilities that do not become statutory barred. For example, withholding taxes. You could be on the hook forever, whenever they catch you. And the other consideration is if there's a filing position that the corporation was taking, the target corporation was taking, and you did not do a due diligence and you did not find it, when you file the tax returns after that, those will all be wrong as well, and those will not be covered under the red. So certainly there's pros and cons. You can do your cost benefit analysis of whether or not you want to do this if your risk tolerance is high, but these are a few considerations that we would recommend that you consider before going with an acquisition, whether you want to do a diligence or not.
Right. So reps and warranties give you some protection, some legal protection, but current, not necessarily into the future.
That's right.
And it might not capture everything, right?
Yeah,
so it's
and
still
there's also a headache of after the fact. If some of the employees that were there during the acquisition have left, you may have to recall what happened during that time. That could be a lot of manpower that would be needed, and dealing with CRA without sufficient support is never a good idea.
Yeah, and the one thing we noticed too, Howard, just off topic to some degree, a lot of companies, when they combine together, they assume they don't have taxable income because, for example, let's say neither of them are tax paying because they had losses. But filing forms on time is also important because
Correct.
a lot of companies think that we won't have any taxable income, so we're okay. But filing forms on time, especially 2 years into the pandemic, is becoming so. Maybe as a reminder that there's late fees, right,
Correct,
to consider as well with forms. So
yeah, so foreign reporting, there's typically quite substantial, depending on how many there are, but could be quite substantial. And there's no statutory barred period as well.
Yeah, so in any M&A transaction, also consider filing things on time to
Correct.
avoid any penalties from
That's
both Canadian and US authorities, depending if it's cross-border transaction or
That's
not.
right.
Okay, right on. Thanks, Howard.
Great,
And by the
thank
way,
you.
you still know how to tie your tie, so that's great. You haven't forgotten as being a young father and over the last couple years of the pandemic, so that's good. You're looking sharp. Okay, Mark, last but not least, of course. Mark is always totally appreciative of the energetic presentation. Mark's maintained that very well over the last couple of years and haven't lost any of your energy, Mark, so that's great. One of the things that you talked about is cash flows, right? And how COVID, the pandemic has clearly had impacted of businesses. And you mentioned that the first thing companies should consider is, talk to your auditors about how it's impacted. So if I'm management now and I'm trying to do a cash flow projection, and typically what would it be, 3 or 5 years? How much do companies usually project out to, Mark, approximately?
Typically they do 3 to 5 years, but it could be whatever period they're comfortable with.
Sure. So it doesn't, but typically it would extend beyond a year, or it could be even a short, depending on the circumstances.
The shorter the better, because most clients only have 2 or 3 years of true supportable cash flows.
Right. So one takeaway is, do we encourage companies to consider shortening their time frame given the uncertainty of the world?
Absolutely. That's an amazing question. That's a great question.
Yeah, I can't remember who the audience member was, but
So
yeah, it was somebody.
that's a great question. People think by default it has to be 5 years. When you ask them though, you say year one, you have a good handle on that. Absolutely. Year two, yeah. Year three, no idea. Year four, absolutely not. Year five, couldn't tell you. Okay, then why are you putting it on there? Here's an amazing scenario. You go to Res, you're preparing your cash flows. Res, here's what we're doing next year. Here's the number of contracts we have in the pipeline. Here's some signed offer agreements. Here's a couple of LOIs. Here's this, here's our supply contracts. Here's how we're getting from this point to that point. Year two, we've applied 10% growth in it. Why? Well, because these industries, larger public companies, are all projecting the same amount of growth. Year three, we don't really know. So we're just going to cap it at year one and year two. It's not going to impact the overall value. What it does is it decreases the risk. I could tell Carmen there thinking, oh, wouldn't that be amazing? Just a 2-year cash flow at Audit. Perfect. So great question, whoever that was. Absolutely.
So even with that, okay, even with that. So now, because one of your slides talked about, the differences between September 30th and December 31st, given that the pandemic is moving so quickly, right? What we knew 3 months ago versus what we know today is different.
Mhm.
In fact, we thought this week would be a grand reopening of British Columbia, right?
Mhm.
That's what we believed 2 months ago, and it's not happening because of the Delta variant returning and so forth. So even if I'm doing 2-year projection, like let's say I originally did 5 years, now I'm saying, okay, I can't project that far. How do companies even assess that? Do we assume life is getting back to normal in a year? Like I said, I'm doing a 2-year projection now. How do we even handle that uncertainty about cash flows?
That's another amazing question. Can I use this camera? Oh, you're already switched up. Okay. Geez, I got to stay put here. Let me tell you something, okay? Here's what a lot of clients don't quite keep in mind. The cash flow projection you give Erez or Carmen is not a pitch book. You're not trying to show the auditor what an amazing business this is. You're not trying to show exponential growth. What you're trying to do is present some supportable cash flows. That key word that auditors love, supportable, right? So keep that in mind, and that answers your question. You only have 2 years, that's fine, so dial it down. It doesn't have to be a hockey stick. Here's what's supportable. And here's the thing. You want to make your life easier, start from the bottom up. We're not sitting on the patio having a beer saying, you know what, we're going to grow this from 1 to 10 to 15 to 65 million in 4 years. That's great. That's the pitch book. We're thinking this, okay, we're at 1 million now. If we add another 16 staff and open 2 locations at a cost of X $100,000 and increase this and sell this and this and this, now we're going to get to 3. And if we do the same the next year and we have to build this additional, we have to acquire this additional equipment and we have to acquire these additional people and we have to get 6 more contracts. Now we're up to 5. After that, we don't really know. Cap it at there, give that to Res.
Final question. We talk about the discount rate. Okay. If companies' cash flows are difficult to audit, can you increase the discount rate for that risk and still be okay?
So I'll give you 2 answers. From a valuation perspective, yes. Okay, absolutely. The riskier something is, the higher the discount rate. How do the regulators look at that? No, they don't want to see that. I could sit to a regulator and say, look at this. The discount rate was 15% last year. Now it's 20% this year, and I'm really comfortable with it. They're going to say, yeah, but how did they get from 2 million to 5 million? Erez, do you have that detail? The Rez is going to say, well, I don't know, Mark, you said 20% was right. It's going to be a circular. Start from the bottom up. You had 1 factory. To grow to 2 factories, you add another building. You add some staff. Are you going to be able to get the staff? Then you have to have 6 new clients on board. Build it from the bottom up. The discount rate will go up slightly, absolutely. But importantly, you can support it. Keep in mind, it's not a pitch book. This is an exercise in supporting the cash flows.
Thanks very much, Mark. And don't go too far if that's okay. I'm going to come over to your side as well.
Absolutely.
Too. Just give me a bit of a space there. Can I
Yeah,
get you to hold
sure.
this, Mark? Would that be
Absolutely,
all right?
yeah, of course.
Okay, great. Okay, well, thank you everybody for that. And thank you for everybody who's listening as well. We'd also like to special out a thank to all the other individuals and companies that are involved in the public company process, So we'd like to thank the stock exchanges, the Securities Commission, and other regulators who have kind of walked through this pandemic with us and are helping public markets function well. Again, just a quick admin items. There's a survey, so please fill that out. We always want your future ideas and feedback on how we can improve things and other topics to talk about. The slides and the PDF certificate will be emailed to you shortly, so you'll get that in your email. And then the recording of this session will be posted on our website shortly as well. For those who have missed it or want to refer it to others, please feel free to visit our website to watch the seminar. A couple upcoming events too for Davidson and Company. If you want to save the date, every year we do our IFRS update, and that's going to be October 28th. The annual tax update as well. So more to come from Howard and others in the tax department to talk about ongoing tax issues, and that's November 24th. And then of course our annual regulatory and TSX update, which be in 2022 in the new year. All those events are still currently scheduled to be remotely. However, please check our website to see if any updates or whether or not we can change things accordingly. Otherwise, we look forward to seeing you there. A big thank you to our speakers today, to Carmen, to Howard, and to Mark for taking the time to do this today in their busy lives. I thank you, of course, to people in the background here that you don't see, like Bahar, Justin, Sonia, and Matt, for doing all the work behind the scenes. And now we're going to do a draw as well. And again, it's going to be a $100 gift certificate for Starbucks. So we'll do 3 of these. And if you do get one, please come down and invite us for a coffee. We'd love to see you. So Mark, if you don't mind, maybe hand out 3 names and I can read them out. Maybe grab the first one if you don't mind. All right, we got Natasha Chen. Natasha Chen. So I hope you enjoy Starbucks. We'll send you a gift certificate, Natasha, if you can hear us. And the second one is going to be Simon Anderson. Hi, Simon, if you could hear us. Hope you're doing well, and we're going to send you a gift certificate for Starbucks. Please come downtown. I love espressos. Mark puts a little bit extra hot water in his espressos. I like it a little bit stronger, but Mark drinks a lot of coffee. And then the last person, last but not least, is Richard Graham. So Richard will send you a $100 gift certificate as well to Starbucks. And please do come downtown and join us. So that's it for today. You know, the only other parts that we're still contemplating is whether or not we do anything in person for the rest of the year. Stay tuned, check our website. Feel free to reach to any one of us for any sort of update that Davidson and Company is doing. Thanks for participating. Thank you for always supporting our firm. And we look forward to seeing you next time, and have a good rest of your day. Thank you.